Is CSL a buy? Iron ore still $100 per tonne. Gold going crazy. Drew Meredith, welcome to this episode of the Australian Investors Podcast.
I did all this preparation work and you just stole all of it in the first 3 seconds of this latest edition.
Well,
but good to be here, as always.
It's good to have some news. Australian Super fined by ASIC. Adjacent portfolio changes. I'm just coming up. I'm just dropping all those stuff.
Like you do all this preparation and then you're pretty vocal on that Australian Super news too.
Yeah. So Australian Super has been fined. It was thousands of people didn't
get on the socials.
Big on the socials. Didn't get good treatment. That's probably the right way to phrase it. Allegedly.
Allegedly. I mean, pretty interesting that it was self-disclosed by Australia. That's what ASFA were talking about last week, that they disclosed that they hadn't done it over a period of 5 years, but got a big chunky fine, a couple $100 million, wasn't it?
Yeah. And I was just saying that if you pay peanuts, you get monkeys. Is that the saying?
But they're not cheap anymore.
Well, that's it. Yeah,
they're not the lowest cost super funds anymore, so you can't use that anymore.
People that always choose the cheapest things have to expect that you're going to end up with, unfortunately, subpar results a lot of the time.
I think you got to be engaged.
Yeah. And like the industry funds are great for a lot of Australia, obviously, and they do a very good job for a lot of people, but they're not always bulletproof, right? They're not perfect. So that was what I was calling out, is that as you get a bit more aware of what's going on with your money, you should be inclined to pay for things, should be inclined to pay for services. But anyway, what have you been doing? What's been happening this week?
Yeah, more engagement comes with retirement as well. And that's what we notice. People want to ask more questions, and it's very difficult to deal with that when you've got 2.3 million members or thereabouts. So I'm just trying to keep up with what's happening in markets. I mean, you could lead with, instead of AIP 2 cents, we could lead with, is this another global financial crisis? The headlines are popping up very quickly. And unfortunately, a lot of people that are in advice at the moment weren't around back in, or in investments at the moment weren't around back in 2007, 8, and 9. It feels like everything's going incredibly poorly. I'm getting quite a few emails asking, should we be rebalancing? What should we be doing? Where are the opportunities? I'm like, it's fallen 10% from a record high, and it's hit several record highs. What happened in previous crises is it falls 10, and you think, oh, that's not too bad. Then it falls 20, then it falls 30, then it falls 40%. So your capital's almost halved in an extended period of time. And maybe there's a couple of bounces there, but I think we got so used to this idea that every time it falls, it's going to bounce back quickly and back to another all-time high. Not saying that's not the case. Not trying to fearmonger.
It sounds like you're fearmongering. So tell us more. What is going to happen then?
I'm not in the business of making predictions anymore. Anyway, but I think you look at some of these businesses, and Tesla hasn't changed. It's worth 50% less than it was, and this is not just pushing my portfolio, but my fake portfolio. But these companies haven't changed that much in a number of weeks. How much people are willing to pay for them right now has, and clearly it's a lot of sentiment driven. There is nothing fundamental. There's no fundamental issues that have come into the economy outside of the threat of tariffs and what they do. And most of the time, tariffs are pretty short-winded anyway. But I think now more than ever, it's kind of reflecting on the need for proper diversification. Whether that's, I think a key part of that is understanding what you're invested into. If you're in ETFs, how heavily are you exposed to certain companies? Are you blending styles, not just market cap? Are you blending active and passive? All those things come into play now, because looking at, and I mean, even giving context, our portfolios are still up more than 6% for the financial year to date. That's still going to be, fingers crossed, an average level of return for a balanced growth portfolio for the financial year.
Yeah.
So far, anyway.
Past performance indicative, blah, blah, blah.
You throwing the baby out with the bathwater for the Rask Invest portfolios, or?
Nah, mate. No. We moved 100% to cash, just because. I'm kidding. I'm absolutely kidding. Just like there was one commentator he shall not be named, But he's like, we're 100% cash. Your money is safe. Cheers, mate. Like, obviously didn't have a diversified portfolio in the first place. That's why you end up screwing over your investors.
Prefer to be in the market.
Yeah, money's got to go somewhere. So if you go to 100% cash, in my world, you're going to crystallize a heap of tax. You're going to incur costs, and you won't know when to get back in because you were too scared on the way out. You don't know when it's the right time to get back in, and typically you do it at the top. So then you get the next crash on the way down.
We don't have to leave my portfolio up there for so long, do we?
So I was just referring to Drew's portfolio, and you mentioned Tesla down, 40.
It's rallied.
It's rallied. It's on a comeback. But did you see that this week Donald Trump bought there was an exhibition, there was a showroom at the White House. Did you see that?
No, I did not.
So Donald Trump and his buddy Elon, there he is. They were effectively advertising Tesla on the White House lawn. So they brought all these different Teslas to the White House, and then Donald Trump went through with like a price ticket and stuff, and then picked which car he wanted. And the great irony of all this,
surely Cybertruck.
The great irony of all of this is that no, he just chose like the basic one, a red one, just to try and make him more relatable. But he, what's interesting about it is that Donald Trump is actually not allowed to drive the car because of Secret Service rules around presidents. They're not allowed to drive. He hasn't driven for decades, apparently. So don't know what he's going to do with it.
He's only president.
Well, he apparently, like a lot of them, like George Bush and a bunch of them, Joe Biden, actually like cars and like driving cars, but they're just not allowed to. So anyway, he's quote unquote bought this red Tesla that he won't be able to drive. So maybe he buoys the market. Maybe
there's an investment opportunity there. The ex-president's, neighborhood driving track. Like kids have the playground ones where we can put all the presidents out there with traffic lights and pedestrian crossings.
Well, it's interesting because George Bush, I believe, at one of his ranches or something like this. I don't know. I could be making up fake news, but apparently the article that I was reading, the Secret Service let him drive a Ford F-150, the new model Ford F-150 at one of the ranches or cattle stations over there. And he was doing burnouts and stuff. And then they were on Jay Leno and doing all this sort of stuff with a bunch of them. So, like, it's interesting. Anyway, I don't know if that's a good signal though, because Ford has not performed as well. The everything portfolio down 8.8%. This is the best one, which is yours truly's down 7.3%. Gus showing us what a proper market collapse can do to an leveraged ETF, down 15% in 1 week, basically.
Very similar returns, yeah.
Yeah, we're all we're colluding. Ooh. Dizzy Rascals down 8.5% for the year. KKR plumbing at negative 27%. Vulcan on a tear, coming back from nearly 30% down to be only down 21% or 22% for the year. So there's a bit of red, Drew.
But yeah, let's be clear. These aren't portfolios we manage or recommend or generally even build ourselves. These were, and I won't say moonshot portfolios, but they were aggressive portfolios with the intention of holding them for a year and riding whether it was momentum or a rebound in some sort of sector.
Absolutely.
I think, and if there's any lesson from these, and we were texting the other night about lessons, it's got to be one of position sizing and potentially one of rebalancing. But I don't think we're going to touch on that yet. But position sizing, you can see how, and how difficult it can be for an individual investor to have a single large position in a company, because you're very tempted to either cut or double down on my biggest holding at the moment, or my biggest loser at the moment. But without a framework, that becomes incredibly difficult to do.
It's impossible, isn't it? Yeah, and that's where you're just guessing. Like if you asked people 2 months ago whether they should see a financial advisor or invest with a professional, they would have been like, "Why do I need to do that? I've got, I've done this, I've done that. In my investing over the last 2 years, I've done this." Yeah, but the last 2 years, we said at the beginning of 2024, 2023, we were saying to people on this podcast, it's probably the best time ever to invest in a diversified portfolio.
We were right on that.
And we were right. Almost every asset class has just absolutely been on a tear in total return terms. It does not like a 2 year does not make a career investor. I can tell you that. So I went into the Rask community and I said, help, we need help. We're thinking, can we have one trade per quarter on our portfolios? Is that okay, dear lords? And then Mark said, you can't change the rules of the game. Stick to the original rules. It can't be like a normal tipping service. That would forget the horror shows and just gloat with the winners at the end of the year. Kylie said,
for the barbecue.
surely we should remove VUL from Dizzy Rascals. Tim says, swap Vulcan for Stealth Global. Gregory probably had the best, I think, comment here. Got a lot of likes. One trade per quarter is too infrequent for podcast giggles. I propose one trade a month is allowed, but you cannot execute the trade on your own portfolio. So you can execute one buy/sell on Drew's portfolio, and he can do the same to yours.
That's amazing.
Once a month. Odd months, you make the trade first. Even months, Drew makes the trade first. I like
this is a perfect setup for catching a falling knife, isn't it?
So I'm just curious, based on what we have in our portfolios, if you looked at my portfolio, Drew, if you were either trying to sabotage or help me out, which of these positions would you sell or buy? We've got Fang, Gigas, I think that's a Monroe, Home Depot, the Global Health, the Global X OZXX, which is Aussie X Financial Resources, ResMed, RPM Global, Wes Farmers, XRF Scientific. Like, what would you buy or sell? Or
I don't think you went hard enough on GGUS when you first bought it. So if I'm going to win this, I even need the market to tank, or for you to be more leveraged to the market than I am.
Interesting. So, okay, if I was going to do yours, what I would do is I can't remember, what was one of your biggest positions in weighting?
I feel like you should only be allowed to buy. I think it should be the key. Not to sell something.
If I was going to just try and return the favor to you, I would probably take whatever your biggest position was, which I think was like the
one of the funds at the
Monroe
top,
or the Yarra Capital Mid Cap Fund. I would take that and then plow it all into SNAS. SNAS being the leveraged inverse ETF on the NASDAQ. Because I think the NASDAQ might pop back before the end of the year. And if it does, you would go 2.5 times the opposite direction.
Why aren't we supposed to be supporting each other and helping each other?
We can help the community out. If we went into the community portfolio, surely we would sell Vulcan. Like, that is dead cat pounce and all that, but surely.
The trend's against KKR though.
But we're not down.
It was up 30 and it's down 27, isn't it?
Yeah. But we would probably, I don't know, I feel like KKR is a brilliant business. I feel like if anything, it would probably be an interesting business to buy, not sell. But you know how you were talking about financial Armageddon before and you're making your predictions. Do you genuinely think, based on your vast experience in financial markets, Drew Meredith, do you honestly think that this feels anything like the global financial crisis?
No, it doesn't. I mean, it's always dangerous making statements like that are recorded and people can listen to again. I was going through a few articles on Bloomberg during the week, and like 10% pullbacks in the market are healthy. They're not healthy.
Well,
it's really bad
to be honest. They probably are.
They take the froth out. Markets. Everyone seemed to think the market was overvalued, but it was still going up. So 10% brings us back to where we were in September, which was also an all-time high at the time. And I think it's a good reminder to people that markets are volatile. I honestly, it also probably wouldn't hurt. I wouldn't be surprised, and me and Jamie talk about this all the time. If you see a period where markets trade sideways, they go up a little bit, they go down a little bit, and we have a year of no real direction. Like, we've had a massively momentum-driven market, something that index funds have contributed to, and the popularity of index because it's adding more to the large caps. But we've had flat markets before, and it doesn't have to last forever. But that's where other parts play a role: asset allocation, diversification. We've talked about gold and all these other things. The GFC was something completely different. It was leverage on leverage on leverage. It was structured products. It was lending. It was a housing market crisis. And the difference, the benefit we have now is if anything truly goes wrong, we're going to get an immediate cut in interest rates. Yeah. And that will be impactful. Like, the economy itself isn't great, but it's also not incredibly bad.
Yeah. Yeah, I agree. Yeah.
Because we're talking about Main Street, No, we're talking about
What are we doing?
High Street, not Main Street. The
Okay.
market's High Street.
High Street?
Yeah.
Okay, I'm not sure I follow, but I'm thinking Collins Street or
Collins
Wall
Street.
Street.
High Street, Melbourne, yeah, whatever you want to call it, Armadale.
Yeah. So, yeah, there are always pockets of weakness. The problem that you have with these things is similar to the GFC, right? Yeah, like CDOs, and you had really perverse incentives for financial institutions. Whereas you said it, I think, best at the top of the show, which is that a lot of what we're seeing at the moment is politically induced. It's like they're actively making a decision to shake things up, as opposed to the GFC, which just spiraled out of control and it was like on the brink. Whereas this is something that you could see a moderation of pretty quickly. Obviously, we don't know, and that's why I brought up Trump before. Is we don't know what the next 6 days, let alone 6 months, hold. But over the long term, there seems to be a very long arc to Trump's maneuvers
Corporate America, yeah.
and the Republican Party, but all just, to be honest, geopolitics globally. If you were to zoom out and take a 20-year view of potentially what the political party is trying to do to America, I think you would have a much better chance of understanding what the implications are to your portfolio. And over the last 20 years, we've seen a big tilt in power, economic power, to Asia. And ultimately, what you're seeing, I think, this is just my interpretation or inference, Drew, is that what you're just seeing is you're seeing an American president who's trying to flex and bring back more control to like the greenback as a currency, to American business, and effectively the American economy is what you're seeing. Is you're just trying to see, you're seeing, I don't know if you wanted to call it an American tax, but you're effectively seeing an American tax on global stability, in that America spends the most on defense, like 10 times more than basically anyone else. Their companies, the American companies, provide the world with the internet effectively. They provide all of the e-commerce, the cloud computing, the healthcare systems. If you just look around your house or your place of work, and as a business person, I'm sure he's recognized that that's a lot of American intellectual property. That is American intellectual property. And if you go back, I think it was 3 weeks ago, we mentioned on the show that I think I made the point that if you, like, I was driving down the Monash Freeway in Melbourne, and I was surrounded by electric vehicles that were Chinese. And you look here in your office or whatever, and there's more made in China phrases than you've probably ever seen. So that's what we're seeing, is kind of this tension between the economic superpowers, I think, over a long arc. What does it mean for your portfolio? Well, you just want to make sure it's diversified. You don't want to be all US stocks, all Australian stocks, all in one currency, all in one asset class. You want to make sure that you've diversified and you've thought carefully about the next 20 years, maybe not being exactly the same as the past 20 years. That's my kind of long-term inference. Happy to be challenged and proven wrong, but that's where I kind of stand on it.
Yeah, and whenever you have trade wars like this, it's usually a resetting of things that had happened over the last 10 or 20 years. And Trump did it previously, but it was more focused on China. And, everywhere across the world, there's subsidies or there's tariffs. Like the European Union has tariffs on any number of things. Like I think I was looking last night, and they've added 200% tariff to US elk. To 50% tariff to US whiskey. So the US has gone, all right, well, we'll put 200 on French wine. And what almost always happens is the cost just gets passed on to the consumer, and the risk is that has an impact on the economy if it goes to that point. And a lot of this is just trying to get new trade deals agreed in a lot of cases. I did look at what happened to the market. I thought it was very similar last time when Trump came into power, but it was actually, the market was already up 4% by this time of Trump's last term. And this is down like 12, 15. But I think he's, not that he's got a big amount, he's more focused on what he's going to achieve this time. I did have a question for you. In light of recent performances and changes, do you wish China was back in the FANG ETF? I know it made a lot of sense at the time. There was political issues. There was a lot was happening, and you couldn't really invest in the likes of Alibaba and Tencent. but those two companies holding up exceptionally well in what's to sell off in every other part of the tech sector in the US.
The answer is no, Drew. I don't own it. We don't own it. I don't own FANG. We do have FANG stocks in the S&P 500 ETF that we hold, but the answer is no, because if someone wanted to invest in Chinese stocks, they can do that themselves. They don't necessarily need the FANG stocks to do it. That's my answer to that question. What do you think? You're one of the most substantial investors in FANG, I thought.
It was more this idea to pull out the point that China's outperforming. Like you'd have every reason to say, China should be weak because of all the tariffs that are coming in, but their tech sector is just quietly pumping out solid returns, not being hit by the volatility, investing in all the same areas that US tech's investing into, and I think being one of the top performing markets this year.
It's interesting if you look at like the journey of the blending of politics and business in the two superpowers like China and Jack Ma out from Alibaba versus Elon Musk and the US Oval Office. Effectively, you've got the guy that supported the US president selling his cars on the front lawn of the White House, and then the other side, you've got a guy going missing for months at a time
for questioning
anything. So you can't. It's like a tale of two worlds, right? And effectively, that symbolizes, and it's kind of like, for me, it's emblematic of like the way business is perceived and not just business, but also government policy and those types of things. And the thing that I've been interested in over the past 4 or 5 years is how the US tries to wrestle back control, and when it wrestles back control, if it can wrestle back control. And you've probably had, it's probably fair to say in the US, you may have had some political parties in power that have been either distracted or less willing to make those decisions. And that's probably what's led us here. And so it's a really interesting thing. And underpinning all of this, I still have, doubts is probably a strong word, but I still have a perception that shareholders wouldn't be as well rewarded under a quasi-communist regime as they would in a capitalistic society. And so for me personally, do I think that those types of stocks should be in a US listed type of vehicle? No. But should investors still have exposure? Yeah.
Probably, yeah.
Yeah.
I mean, it's amazing.
Do you guys would use like Chinese type exposures, wouldn't you?
I mean, we've done some direct. Alibaba is listed on the New York. You could buy it as an ADR in the past, and then we tend to be more actively managed in Asia, given the edge for active management over, market cap weighted emerging market exposure. I mean, Alibaba's up 60%. It's just in 2025. It's like Trump's good for Alibaba.
Yeah. Well, a lot of, as you know, like a lot of the short-term performances of stock prices is actually not driven by company fundamentals or long-term fundamentals. Yeah, it's driven by sentiment. And the other thing that it would be driven by is money flow. So if a lot of money has all of gone, oh, geez, what's happening in the United States? Who's that guy with the hair and the guy with the electric cars? Let's get away from that and put all of our money somewhere. Well, maybe it goes back to companies like you're talking about that may be insulated from it. And obviously that just drives up the price. Doesn't necessarily mean that the fundamentals of the company are right or whether the legal entity of which that ADR sits upon is robust. But you get the drift in that long-term investing and uncertainty is about zooming out, having an understanding of these things, but ultimately, like what drives performance is company fundamentals over the last 150 years anyway. And so being exposed to companies that grow profits consistently, I think is still a winning formula. And I think that personally, I think that if investors are looking to get out of the market, you have to know where your money's going, and it might go to cash or you might reduce volatility by having fixed income. But the longer your time horizon, the more you should be exposed, because it could easily just go the other way. That's just my 2 cents. Maybe final question on this. Have you and the Atchison and Waddle Partners teams, have you changed anything this year?
Not as a result of this correction. We've just completed our investment committees, and there's a bit of a, let's call it a style rotation. So in making sure globally, and this is the thing with global equity managers, they always have to be fully invested. So there's always going to be, they might sell the top stuff, Tesla and Nvidia, because they want to reduce their exposure, but they've got to buy something. And it's actually value has been outperforming this year. Who knows if it, whether it's going to bring a closer gap to growth, but those more cyclical traditional businesses have actually started to outperform. So that's been one area, and then kind of it's probably as always tilting a little bit more towards active management over passive. So there's still a passive core, but complementing it with that active management, because we know in periods of transition it can help smooth the ride. Along with good asset allocation. But if you look at portfolios of 10% fall in your global equity exposure that was already up like 15% before that, the asset allocation is still where it should be. So then it's a bit more about what's going on inside there.
Yeah, absolutely. It's interesting you mentioned like value. We had Mark Jocham on the show not too long ago talking about, from Global X, sponsor of the show, talking about the GARP ETF, growth at a reasonable price is the phrase. And it's an international shares ETF that invests in reasonably valued companies. And we've had a lot of conversations, obviously you and I, with different investors over the last, say, year or two about diversifying away from the market cap spectrum. So you typically have like top heavy markets. Like you've been bringing this up every year. I think one week you talked about the French market and how top heavy that was. It's about just moving further down the market cap spectrum in order to smooth results. It's not about a lot of novice investors and investors that haven't been investing for more than a few years will be like, it's all or nothing. I'm either in the market or I need to time it and get out. Whereas most professional investors and people that have been doing it a while just know, well, I don't need to do that. I could just blend something else to deflect some of the pain, because if you go all or nothing, you're going to get taxed on the way in and out, or on the way out, and it's going to be pretty painful over your career as an investor. Now, Drew, we do have some questions, unless there's any other news stories that jumped out at you this week. No, here we go. Is CSL a buy?
Yes.
Okay, good to know.
Yeah.
All right. Let's get into some questions. So
I was going to mention, so this is another one. Let's ignore a lot of the headlines that are coming out at the moment. $5 trillion off the market in 6 months. A couple that I saw that were interesting. Mnuchin, so was that the old head of Treasury? I can't remember what it was. Said stock retreat makes sense. So, a correction makes sense. It was running pretty hard, but I thought this one stood out, which was baby boomers face lasting retirement hit in extended stock rout.
What a headline.
Like, this is something that's trying to trigger people. I don't think they don't want people to sell their stocks, but basically it's saying if this market correction gets worse and worse and worse, and you need to protect, at some point you need to protect your capital, because you're going to run out. If you're spending the same amount and your value's going down, you're going to run out of money. And I think that's scary, and I hate I hate it when headlines come up like that, because then you read it, but then and it all these things, and we naturally, and during times like this, we're naturally tilted towards trying to find these negative things and just reiterate that we should sell everything. So I hate it when they come out. And the article itself isn't too bad. It talks about longevity risk. But the headline is what I'm a little bit concerned about. So I'm always, make sure you diversify. Make sure you had a strategy in place before. If not, yes, you should probably change some things to be prepared and you feel more comfortable, but don't throw the baby out.
Here's a really interesting tidbit on the way the financial media works for people that aren't anointed in this world. Typically, the person that writes the article does not choose the headline.
Yeah.
People don't know that. They think that the journalist writes the headline. Not all, they can suggest one and they'll propose one, but oftentimes someone else writes the headline. And what are they incentivized to do? Yeah, good on you, Drew. Great article. But I'm going to say bloodbath, ASX retirement nightmare, just so that my job seems like I've made some influence on this article. But great article. That's ultimately what happens.
Like they've scored. There's actually scoreboards within media outlets that are showing how well those titles are going.
Exactly, and they know, right? They know immediately what's working, and they need to do it because they need to get people to read their stuff. So it's a really interesting insight into the conflicted incentives of journalism and the way the internet and media works. Is there's their incentive, and then there's yours. That's why when we had Morgan House on the show, the fantastic writer a couple of years ago, he said, it's as much about the source of the news as it is about what the actual news is. Like if you're going to read it, have a scorecard of the source. And the more realistic people are, the more they realize they shouldn't read some of those crazy headlines and those publications.
Or podcasts.
We love headlines. In case anyone's wondering, I do write the headlines. And sometimes there's sometimes I think they're a banger and everyone's like, that's so stupid. But that's actually more of the time, let's be honest. So
you or ChatGPT?
No, we don't use ChatGPT for any of that stuff. So yeah, maybe we should. Maybe we get more downloads. That'd be right in the zeitgeist.
More clickbait for sure.
Yeah. Hey, Chad, clickbait this for us. So we've got some questions sent in. You can send your questions in via the link in your podcast player that says ask a question. Just select the Australian Investors Podcast. We don't know your needs, goals, or objectives. So when you send your question in, make your name funny, generalize your question, and just remember not to act on the information. Speak to a financial planner before you act on the information you hear in any Rask podcast. If you're unfamiliar with what all this means, you can head to www.rask.com.au/FSG. That's our financial services guide to get more information on what general advice means. So Donnie the Dollar Crasher, interesting name. Hi chaps. I followed your general advice about ensuring I have a good portion of my investments overseas. I'm approximately 60-40 invested overseas. I've watched my portfolio grow from both share price appreciation and also from the fall of the AUD versus USD. That was the extent of that question. So that's quite interesting to see, I guess, is the just drift of currency, Drew. What do you make of that?
Yeah, I was actually just brought that up while I was reading the question. And I looked at this chart. So you can look at the Aussie dollar US dollar, and this matters because stronger Aussie dollar equals bad for Australian investors overseas that are unhedged. Weaker Aussie dollar equals good. I actually just said that in my head so I remember it, not just other people.
Now we know how Drew's brain works.
Good, bad, yeah. All right. But I looked at, I'm like, let's have a look. Surely the dollar's been super volatile in the last 12 months. And I looked at it, we're at 62 cents at the moment. We're at 62 cents in December. So while it feels like everything that could go wrong is going wrong, we're still exactly where we were. And then I looked at the chart for the last 12 months and it's volatile, but the peak is 68 cents and the trough is 62 cents. You're still talking about quite a narrow band given the level of geopolitical volatility happening at the moment. But I'd completely still stands in terms of a view on investing overseas. Income plus growth equals total return. You can get great income in Australia, but to be completely honest, the quality, yes, there's growth, but the quality of growth for Australian investors is much lower than what you can get overseas. And yes, probably been proven wrong so far this year, given growth is negative, but that's 3 months. There's no, as much as you love companies like, Xero, WiseTech, probably world leaders in their own right, they're still not the scale of Apple, Nvidia, Microsoft, and what they've done over 20 years as well. Not saying it either are particularly better than the other, but I continue to see 50-50 split between global and domestic as kind of the starting point from which you make your own decisions.
And I don't know about you, Drew. I feel like the actions taken by the new political establishment, let's say in the United States, I would actually say longer term, those are extremely beneficial for US technology companies.
Yeah, for sure.
Whether or not there's a massive boycott is another thing, but we know from their subscription revenue that it is very, very hard to rip out an entire government department that relies on Microsoft. So
their only risk is themselves.
Yeah. So with that said, it was also quite interesting to see how many of those gigantic technology companies and so on actually cut all of their DEI policies. So all the diversity, equity, inclusion principles. It shows you kind of like where their incentive is to kind of to go along, you got to get along, and effectively just whatever's happening at the political level is what these companies are going to exploit. And so if it's interesting that you mentioned the currency, I'm going to actually bring up a chart for people that are watching because it illustrates a really fascinating point for Australian investors, I think. So this chart, it actually shows over time, never mind the axes down the bottom, it actually shows the Australian dollar through time. We refer to it quite a bit on the show. There was a time when the Australian dollar was over $1 US, but that was in 2011.
The mining boom.
Yeah, and then the other time was in 1982. So keep that in mind.
The year I was born.
Oh, whew, good vintage.
Yeah.
Is that pre-franking credits?
It is pre-franking credits.
Back to the task at hand. So what actually happens with our currency, which is very, very unique, is that if you look here in 2008, our currency fetched, well, what's that? Like nearly, let's add 95, 96 cents.
$1.20 at some point.
Right. But wait for this, Drew. If it, in the GFC, as the stock market was falling, the Australian dollar went straight down to around about 65 cents. So it fell from over 90 to 65. And what that would have done is, even if you were investing in the United States and your stocks got whacked because the US stock market also fell, the fact that your currency also fell meant that the value in Australian dollars of your US shares was significantly better off than had it just been, all in, say, Australia or something like that. So the currency impact that we often, not always, but often feel in Australia is positive during negative economic shocks. As an additional benefit to that, had you held in the GFC, say, for example, BHP or CSL or Rio Tinto shares, effectively you would have benefited because the products that those companies sell are in US dollars.
Yep. CSL, perfect example.
Perfect example, the blood plasma, right? So you think about that and you actually get this nice insulating feeling. And the same thing happened in February 2020. It wasn't as dramatic of a decline, but you saw that then too. I don't know if it's going to repeat, Drew, but I think the value of our currency actually is a benefit for people when it comes to long-term investing because it diversifies and it actually is shown to help us through those market crashes.
It's like an automatic stabilizer. And so far it's been stabilizing a lot. I do remember back in February 2020, so you saw when it fell, it actually bounced back incredibly quickly. And there weren't many hedged because of what the dollar had done forever. There weren't many hedged options for unhedged investments, but we identified that it had fallen to 63 cents in the lead up to the pandemic and switched to a hedged option. And the difference in return was something like 15% over that period of time because the rallying dollar impacted on markets. Not saying we can time it, not saying you can time it, but a hedging decision was made and we found the instrument to be able to hedge at the time.
You guys also bought a lot of direct preference shares. Yeah, that was a really good move. I remember that. That was a really good move.
Doesn't seem like it at the time.
No. Nothing that. What the old Buffett cliche, which is what's comfortable is rarely profitable. So some things should be uncomfortable, not all of them, let's be honest. But that's a good yardstick. So Gota wrote in, I think it is Goata, Gota. And it says, "G'day."
Maybe it's a goatee.
Maybe we need to get goatees. G'day. When you speak about percentage of stock allocation in a portfolio, like 5 to 10% in gold, is that referring to stock quantity or value quantity? Thanks for your time. Really enjoy the podcast. This is actually quite an interesting question because it's like, how do you actually determine diversification limits? My interpretation of this, Drew, is when you have a portfolio, what's the value of it at the time? That's how I think, not about the quantity necessarily. But it's interesting because some different fund managers and professional investors actually think about diversification of their cost base, which is quite interesting. So they'll think about things like free carry and think about things like what was my
on a profit and they sold it and
or they let their winners run and they think about the original amount of capital that they tipped in.
Yeah,
it's a bit weird, but I'd say the value.
Yeah, I mean, we're dealing with direct investors every day, so it's all about the value. All they care about is the value that it was yesterday or the value that it is today. They're not worried about what they paid for it in most occasions, only when they sell it. And very much, and the framework of this starts. So we you'd start at asset allocation level and you set your cash, fixed interest, equities. Then you go, what's split in equities? Or if it's alternatives, then it's like, all right, we're going to have 6 investments in alternatives and we're going to do them equally. Maybe I should say 5, then 20% go into each. So if there's 10% in alternatives and 20% goes into each, then gold is going to have 2% of that bucket. So we really think about it as the breakdown of each asset class and then the individual investments in there. But it's very much the value that you're putting into that of your total portfolio, not of your individual asset classes.
Agreed. Thanks for breaking that down for us. I think that that question may have come about because last week we had a comment about like stock by stock weightings, and you mentioned different weightings, like if a position fell by 50%, what that might trigger in that individual stock line rather than the overall portfolio. So that was a good question. There was a question I'd like to drop down to, which is Wing It Investing Proprietary Limited. Now, interestingly, Drew, Wing It Investing Proprietary Limited is written in, and we've got the question here. I then searched the ABN register, the Australian Business Register, to see if there was any Wing It.
There is not.
There isn't, but there is Wing. There's Wing In. There is Wangi. There is Wang, Wonga. A lot of people. I don't know if that's creative.
Chicken Wing. Chicken Wing It. Maybe it's Chicken Wing It.
Chicken Wing It. If you're going to name your company something, at least name it something fun. That's what they all say. So Wing It Investing Proprietary Limited writes in and says, as the market has been dropping, my super has also gone down. Would I be right in saying if I put money in super, would you make roughly the same gain as finding an ETF at a bargain price? Obviously considering the fees. Thanks. Yes?
Let's go. If you put money, it depends what you're investing your super into.
True, it might be diversified.
Yeah, so in most cases, your super is going to be in a MySuper product that's probably only going to have, not only, but it's going to have 80% in growth assets versus 20% in defensive assets. So you're buying 20% of bonds at the same time. Whereas if you're going out and buying a direct ETF that only invests in equities, you're probably getting that at a bigger discount than you are this diversified pool of assets. But the other thing, on the other end, is that portfolio won't have reduced as far as the equities at the same time. So, but if it's like for like investment and you're buying the ETF here or there, yes, it's going to be the same.
Yeah. It's interesting because I feel like this question's almost come from the perspective of a self-managed super fund, in which case, yeah, it's the same. It's just a brokerage account that you have access to, or your financial advisor's managing for you. So it's the same thing. You would, in many respects, if you're closer to retirement or in retirement, it would make more sense to put money into super to do that because of the tax effectiveness. But I just looked at the Australian super balance strategy, and it has around about 60%, say, in international and Aussie shares. So 60% of every dollar that goes in is going to be into those things, and the other stuff is all that unlisted mumbo jumbo that it's not going to make a difference what time of the day you put money in, basically. But for the most part, the question has truth to it. There was a second part to this question, and I know we've talked about this before, but I'll briefly comment on it here with you, Drew. Are there any pros and cons of buying companies that offer DRPs, like dividend reinvestment plans? Yeah, no?
No, as I've said, I prefer to have my money and then decide where to deploy it with a strategy rather than be overweighting companies that are doing well, paying bigger dividends. I don't think so. And I think it's pretty, unless you're investing outside the larger company, it's pretty standard to be able to get a dividend reinvestment plan. And you're essentially making a new investment back into a business. So I don't see, it doesn't mean the company's any better or worse. And yeah, I don't see a massive benefit either way. It depends on if you want to automate your investing and back into those companies. Yeah, it can be beneficial, but you're still taxed on everything that comes out of it.
We might end today's questioning with this final question, which it was a bit of a trap.
You're not answering that one.
It's a bit of a trap. And did you want to read it out, Drew?
Is there a play on words here? Evil begin?
Yeah. So did you want to read that out again? I think it's Ivor.
Ivor begin?
You're putting an E in there instead of a U, Drew.
Gun. I still don't get it.
Okay, so Ivor Begun asks, it's meant they were hoping we said it fast. Just for people that are playing along at home, one more time. Ivor Begun asks, with all the turmoil in the markets, it's understandable
Still
to
don't
want
get it.
peace of mind with a bit more cash in the bank. So do you sell your winners, locking in
Is
profits,
it one we shouldn't say?
but bringing their brilliant run to an end, or sell your losers, locking in a possible tax write-down, but potentially missing the Elon sacking bounce? Now, I've got to admit, when Elon, a few weeks ago, when people were bloody defacing Teslas and stuff, I was probably getting a bit worried that I might drive down the street in my electric vehicle and someone might come with a bit of like a spray paint can and do some sort of salute on the side of my car, thinking I was associated with that bloke. And I figured maybe Donald Trump jettisons old Elon Musk and feeds him to the wolves. But he actually went the opposite way. He brought him into the house and let him have a showroom on the front lawn. So do you, I will, Ivor Begun, I will just paraphrase this question for you, Drew. Is now the time to get out and then wait for markets to smooth?
I think now, making a decision because the market's fallen 15% is the wrong thing to do. I think you need to reconsider each of the holdings that you have, like you always should, but not in reflective of just the short-term price change that's happened in the last 2 months, or basically in the last 4 weeks. If they're overweight, you probably should have taken the top off them before and been rebalancing, and you should have a framework for that. You can let your winners run, but you can also get free carry, as you're saying, which means you're taking your profits and you've actually invested nothing and it's all profit that's still there. But generally, I see this should be framework and governance that you're already doing, as opposed to, oh no, it's fallen, now I'm going to sell it. That said, if you are overweight, you're still up significantly from where you were, probably when you bought it, and you've still had a very good run in a lot of these companies. So it wouldn't hurt to, probably wouldn't hurt to be adjusting. But I think the key is making sure each time this happens, and this could happen at least once, usually it happens once a year, that this isn't the trigger every year for you to adjust your portfolio, because it's going to be inefficient. You're going to end up with worse returns than what you could have achieved. So, setting a date, setting a process to review, as opposed to trying to time the market.
So there are two myths that I'm not 100% sure are actually truth in investing. The first one is that apparently Fidelity did a study of all of their clients and they found that the ones that were dead were the best investors. That's actually a myth that's made up by long-term investors to try and make you think that doing nothing actually makes you the most money. For the most part, probably not touching your money is a good thing. However, there is another side that is incorrect, and that is around rebalancing and multi-asset portfolios and so on and so forth. There are some other things that are important to keep in mind. That there's this myth. I tried to do this analysis and I kind of got there, but I wasn't 100% sure. And it's that the stock market has a pullback on average once every 357 days, or once a year. And it kind of backtracked to a UBS research note that then backtracked to someone else, and it was kind of like who actually did the research. But if you just take it as read, and we take those two myths as facts that confirm our beliefs, what we're effectively saying is, once a year, be prepared that the market's going to fall. Second of all, try not to sell. And I feel like that's just pretty good general wisdom for investing over the long term, Drew. And for the most part, that's probably what's worked for most investors over the past 30 to 50 years. So, Drew, we do have to do our usual ceremony. We have to get your dad joke out. And Ivor Biggin will have to write back in and say what the joke was, just to clarify it for everyone on the show if you haven't already picked up on that. And I will say that anyone who wrote in, whether you're Ivor or Donnie, Goda, winging it.
You can tell me after we go off air.
Okay. If you do know what the joke is, or that the play on words is, be sure to let us know. But Drew, we've got to get your dad joke for the week.
I might need to. You go ahead.
I was going to say, if you want financial planning advice, don't forget to reach out. The link in your podcast player or on YouTube in the description. Just smack the one that says financial planning, and you'll get matched to a financial planner and get good advice, particularly when it's uncertain times. Drew, over to you.
I was making a joke about retirement. It did not work. All right, what about the second one?
That's pretty good. That's pretty good. That's pretty good.
It's all about the delivery, I think. Sometimes.
It is. No, but I feel like that's pretty good. I give you a 5 for that.
And I found a book called How to Solve 50% of Your Problems. So I bought 2.
That's maths, right?
That's maths. Smart.
That's good. That's very smart indeed.
Yeah, I'm trying to get 10 out of 10 by putting 2 bad jokes together.
You played you doubled down on it. That's pretty good, mate. Well, it's been an honor and a privilege to speak to you this week. We got a CSL buy alert, strong buy coming from Dr. Andrew Deremeth. If you want to reach out to Drew, head to wattlepartners.com.au or the link in your podcast player. Drew and Meredith, as always, thanks for joining me.
Good to see you.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.